one beautiful question, question number 13. I think it's updated in the new syllabus, right? New syllabus update. Previously, it was not there in the study material. Now, company X is engaged in the exploration and development of the oil and gas block. Now, company X currently holds a participating interest in the producing block. There is one company, okay? How do they do? What they do? They're into like Reliance Industries or whoever. They're into exploration of the oil. Now, there is one block called AWM01. They have got so many business there. They explore it. They're like MRPL. They do it, so processing and all. There's one block in one place, Assam or God knows where it is, AWM01. And that in that block, company X owns 30%. Now question comes, who owns balance? 60% is owned by Y and 10% is owned by Z. Now what it is? Okay, now let us read. We don't know what it is. The above block, they are entered into an unincorporated joint venture. Is it possible that unincorporated joint venture you can enter? Like that, it sounds like it's a joint arrangement. Under joint arrangement, it can be a joint operation or a joint venture, but they use the word called a joint venture. So our mind will go become think that it must be a joint venture. Company Y is the operator of the block, because if you are a joint venture, you are called a joint venturer. How can you be called a joint operator? That means it must be a joint operation. Y is the operator and X and YZ are the joint operators. Means it sounds like in this block, the control is done by Y. Because Y is the operator, no? Operator of this block. And X and Z are the joint operators. No, question, no, I don't know. Somebody may interpret it like this. Now we don't know exactly what is the problem, we don't know. See, the languages comes like this. The company Y incurs all the expenditure on behalf of the joint venture and raise the cash calls to company X and Z. That means the operator, maybe we can understand like this. This operator is the like a managing partner. There are partners, but Y is like a managing partner. He will take all the actions. He will explore the oil. He will send it. He will sell it, and he will ask the cash from X and Z at each month end in respect of their share of expenditure of the joint venture. Now, all the manpower and requisite facilities are owned by the joint venture and owned by all the joint operators. So unnecessarily they are using the word called joint venture. Joint venture has got no relevance here. You call it joint operation, understood, because it's an unincorporated. Why you have to tell joint venture? So it's somebody they are trying to confuse you. Don't worry. We'll proceed further and understand. For the past few months, due to liquidity issues, the company Z defaulted in the payment of cash. Therefore, the Y issued a notice to them and they said, you get lost now. You cannot be continuing like this. I am incurring cost and you are not paying me. However, Z filed one arbitrator, went to the arbitrator on 30th April. So on first I said get lost, Y said get lost, and on 30th he went for arbitration. Now the financial performance of the company had not improved. Therefore, they decided to withdraw from this block. Who? This Z. And entered into a sale agreement with the X and Y. They said, okay, go into the arbitrator and arbitrator will sell something. First of all, my financial position itself is not good. Why I should pursue all this thing? So he says that forget, I am going to come out of this. So my 10% stake is there, right? I am going to sell to both of them. How much? As per the terms of the agreement, that means on 31st May, they enter into an agreement where X will get 33.33% of this 10% and Y will get 66.67% of the 10%. Understood the story up to here? Okay, some type of an arrangement was there. One of the party was not able to pay. So he said, I will give my share back to you. You take into ratio of 33 and 67. Now company X is required to pay 1 lakh for this 33% share. So company X will pay 1 lakh to Z, the selling of the stake, seller. Now after signing of the sale contract, now why approach the government of India? Because it's an oil, no? The moment you have got a PSC, production sharing contract. Okay, these are all different terminologies you will come across. Okay, profit petroleum, cost petroleum. These are all the oil industry terminologies. Something you have to give to the government also. Otherwise, government will permit you to explore oil in India. And they said, please remove Z because Z is no more from this block now. And government approved when? Only on 30th June. 31st May, this contract happened, the contract payment and all happened. On 30th June, the government approved. Is that approval substantive? The government approval for the modification is very essential in which they operate. It's that without their approval, you cannot continue further. You remember one Competition Commission of India, rubber industries to join. When is the acquisition date? When the approval. So in this case, which is the acquisition date? Acquisition actually Z, company X took over the stake of Z on 31st May. Did the acquisition date 31st May or 30th June? When? 30th June. Why? Because the government's approval is substantive. If it is 30th June, then these values are important for me. X company values are important on this day because acquisition is this. Now they have given you the balance sheets, complete balance sheets. We need not go into the details. It's a very simple balance sheet. Now the fair value of the PP and development CWIP of Z as per market participant approach is 5 lakh and 2 lakh. Now who is this market participant approach? What is the market participant approach? Market participant approach, this terminology will come in Ind AS 113. 113 says that is called there is one standard for fair valuation only. When you value, you have to keep in mind the participants in the market. It's called a fair value. So their book value is 3 lakh and 1 lakh. These two items. 3 lakh and 1 lakh, PP and development cost on 30th June. This is fair valued to be 5 lakh and 2 lakhs. Fair value of all the assets and liabilities to be at their book value only except cash and cash equivalent, because cash and cash equivalents are not acquired by the company X. Yeah, meaningless. No, you give me your cash, I'll pay you my cash. So they said, I will not take your cash. Other things, this 1 lakh is paid for entire financial statement, balance sheet, except cash. Tax rate is 30%. Why? Deferred tax. Now, this sentence they removed in the new syllabus. As per Ind AS 28, all the joint operators are joint venturers, whereby each parties have got the joint control of the arrangement, have the right to the net assets of the arrangement, and therefore every operator record their share of assets and liabilities. It's such a confusing statement, no? It's a total confusing statement. See, what they are trying to tell, as per Ind AS 28, joint operators are joint venture systems. If that is the case, on 31st balance sheet, or say 30th June, there should be one item called investment in the joint venture. Should have been there, no? Where is that? Not there. Or somewhere, some investment should have been there. So, now in the new syllabus, what they have done, no? They removed this sentence and added one beautiful sentence called as per 111, very correct reference of the standard. It is a joint operation whereby every joint operator will record its share of assets and liabilities. Perfect. Now you get a clarity. That means all time what they were telling, no joint venture, it is never ever joint venture. It was a joint operation and we used to record our share. Now what you need to tell, whether the above acquisition is the business acquisition or asset acquisition. Nice question. Second, what is my acquisition date? Easy, 30th June. Prepare the journal entries for above transaction. What journal entry? Goodwill calculation. Draft the balance sheet of X. on the basis of acquisition date. And the last is this case of step acquisition, because already you are holding in that block some 30%. You additionally take, is it a step acquisition? Explain. In the new syllabus, they have removed this sentence. I will explain you. Okay. So first thing we will move. Okay. Before we proceed, I would like to say something. This is when before new syllabus came, only at that time I had written that. Okay. So there is an operator need to record there. It is actually 111. Ind AS 28 is given only to confuse the students. Okay. We should treat it as a joint operation. This I wrote in my earlier comments before the new syllabus study material came. So when I saw the new syllabus study material and they removed this and gave this sentence, now I felt very happy. Because if we we have to make such assumptions. Question can be mistake. Question can be confusing. So we have to try to figure out what exactly they are trying to tell. Followed, no? So now there is no confusion. It was an operation. And then I went to study material. There is one para 21A, which says that when an entity acquires interest in the joint operation in which the activities of the operation constitutes a business. That means if your joint operation itself is a business, Ind AS 10 as defined in Ind AS 109, it should apply to the extent of its share of principles on business combination according to 109. See, you may say, sir, what is this? It's not, it's an asset acquisition. But the standard Ind AS 111/21A is an amendment. It says that, look, if you have invested in one joint operation, and if that joint operation happens to be a business itself, and if you take over the stake, then that is a business combination. This applies to the acquisition of initial interest, whatever you have taken first time, 30%, and additional interest, 33.33% of 10%. In a joint operation in which the activity of the joint operation constitutes the business. A joint operator might increase its interest in the joint operation by acquiring additional interest. In such cases, the previously held interests are not remeasured. That means the last part of the question, no? Is it step acquisition? You should say, no, it's not a step acquisition. Why? A para number 21A of your Ind AS 103 speaks, 111 speaks about it. Again, we need not go that much of depth. Just for your academic interest, I have given here. It's a actually a very simple, small question. Okay, once we solve this, you will ask such a big hype, such a simple solution. Okay, so we'll write first question 1. Company X acquired participating rights of Z . 1. The output exists. Which is nothing but oil. What is the output here? Because it is a business asset. Because you have got a machineries, you have got a processors, you extract crude oil, and the crude oil is the output. That means it is a business. Second, the manpower, machineries, are owned by joint operators which are inputs and processes. Thus, acquisition of PI, participating interest of Z, amounts to business combination. See, what does your 111 says? Somebody must have been having some joint operation. Acquisition of the participating interest of Z amounts to business combination. It's not asset acquisition. Now, what is my base for this? You need not quote the standards and all here. The base goes like 111. I have given you para number also. If you open the study material, you see this. Because till that time, I was also not clear what they are trying to tell here. It says that, look, if you are a joint operator, is that joint operation a business in itself? Okay, for this you have to check, is that business has got input, process, output? Yes, in this case, AW1 is a business as such, because you have got an input there, you have got processes, and you have got a crude oil as an output. Now, you may be having some interest there, and you take additional interest of somebody else. Now, how should you treat this? So, para 24A says that it should be treated as a business combination and not asset acquisition. We can say it is an amendment, it is an hard-coded thing, this is what standard says. And now why the standard says? Because somebody must have raised a query to ICAI. This is happening in my company, what should I do it? Then ICAI realized, yeah, there is one gap. There is no clarity as such. So ICAI amends the standard to include this type of cases. Are you clear? But if this question comes in the examination, you may have to write little more theory here. You have to talk about Ind AS 103 says, what is business? Business means integrated set of activity having output, okay, giving investment income or other income, and it should have inputs and the processes and the output. An entity must gain control over those activities. So first you explain what is business as per 103. Then you say that in the given case, company X acquired the participating rights, output is existing, inputs are existing. Where is these inputs? So processes are there. Therefore, this acquisition will fall under business combination, whatever we have written. What is my second question? When is the acquisition date? Right, question 2. Since GOI approval is a substantive, that means without this you cannot continue production. Unless, that means you, this whatever agreements or understanding you have, no, it has got no legal existence unless GOI is approved. The acquisition date is 30th June 2011. Since the acquisition is substantive, so approval is substantive, acquisition date is. Now, how do you write the theory in the exam? First of all, you will write, explain something there. Like, what do you mean by an acquisition date? You remember we discussed initially. Acquisition date is the date in which the control is being transferred. Generally, it is the closing date. However, the legal agreement may give you the dates before that or that. But ultimately, on which day you get really the control. Now, there is one agreement between the X and Z on 31st May. But literally, using that agreement, you cannot prove anything. That means control didn't transfer on that day. The day government approved, that day really you have got the right. Because till that day, who is the owner of that 10%? Z himself is the owner. Because government didn't agree. Tomorrow they may cancel it. So your approval business combination date is 30th June. Followed, no? So again, I don't know which form the examination question may come, but be prepared. Third, what is the third thing? They asked me journal entry. Can I pass the journal entry? Yes, please. Why? Why they didn't tell? In whose books we have to pass the journal entry? X. No, so why we have to bother? What why give? If they would have asked me what pass in the books of Y also, then I should have thought what purchase consideration. Who? X doesn't have a control. Yeah, see, why we have to do? Because this is what your standard says. When you take the additional stake in one joint operation, which itself is a business, you should account that additional stake as a business combination. No, it's a joint operation, they say, not joint control. Don't get confused with that. The 21A says joint operation. See, don't go into that analysis. The simplicity, in simple, what I can say, you have got a joint operation. If you take additional stake in that joint operation, you have to account it like business combination. So whatever journal entries of business combination, that should be posted in the joint operators book. Why? That is between Y and Z, no. That Y will pass. Whatever consideration Y pays, Y will also account like a business combination only. For his portion, 66.67%. We will record in our books 33.37% of that 10%. Which one? We will record the gain or loss to the extent of other person. But here we are taking a stake, no, not individual assets there. Again, see, my point is this question is totally silent on so many aspects. But what I feel, this must be a real life case where somebody really faced. So what they have done, they have taken some extract of that question given to you. And what they are asking you, just pass the journal entry. Yeah, if we sit and analyze, then we need more information. With this much of information, we really will not be able to conclude. You have to make certain assumptions. So whatever I am telling you certain assumptions. High probability that this question will come as it is. Very high probability. Because students would not have understood it, first of all. What exactly is they are trying. Because at least new syllabus, okay. In the previous syllabus, it was joined. They said Ind AS 28. How can they say Ind AS 28? They should have told 111. Because if you tell 111, if you open the study material, whatever I told, no, para 21A, you will find in 111 there. Ind AS 28, you will not find anything. Business combination and all. Again, see, at this point of time, I will not be able to tell you why a company Y will do, because who is controlling whom, I am not clear in that. No, if you ask me, both will prepare as 111 only, because it is a joint operation. It doesn't matter who is holding 60%, who is holding 40%. Both are joint operations. So you have to take your share and you have to account it like a business combination. It need not be. No, who do we know what is any decision? Who takes the decision? He does the activities. He does the execution. Who takes the decision? Have they told you? There can be unanimous decision, no? No, they said it is an unincorporated entity, right? We started with that only, right? So 60% is the profit sharing percentage. It's not a decision making percentage. No? It's not a company only. That's what I'm telling. It's a joint operation. So in joint operation, you don't have any worry. So which journal entry to be passed? It's something very similar to your business combination. Okay, can I pass that entry of business combination? No, I need that goodwill calculation. Do I have got the fair value of net assets? No, first we will do working question number 3, working note 1, FVNA, calculation of fair value of net assets. So I will generally follow this format here. Fair value, book value, which is nothing but the tax base, temporary difference, DT, L bar A. So first I will start with the PPE. What is the fair value of PPE? 5 lakhs. What is my share in that? 33.33%, no? In 5 lakh, my share is 33.33, 1,66,650. See, I take over 10%, means whatever assets are there, 10% belongs to me now. It is jointly owned by all the people. It is not owned by one person. Previously, in one asset, means whatever that he must have brought his machine there or PPE. Today, 2 people are going to own it. 66% why? 33% me. What is the book value? Why 3 lakh? Because acquisition date is 30th June, 99,990. So difference is 66,660. Do you have deferred tax asset or liability? 19,998 deferred tax liability. I'll go to the second item. What is my second item? ROU. What is the fair value? 6666. What is the book value? 6666. Why? There is no difference between the book value and the fair value. So no deferred tax impact. Okay. How did I get this? 5 lakh into 33.33%. You see Z Limited book value 3 lakhs into 33.33%. You can write this note, working note you can write. How did we get this number? Then we have got CWIP. What is the fair value? 2 lakh, 33.33% comes to 66,660. Book value is 1 lakh, 33,330. 33.33% comes to 33,330. So you have got 33,333 as a difference. 9,999 as a deferred tax liability. Yes, these are the only two items where we have got a deferred tax impact. Alternatively, you could have done another way also. Taken the book value of the Z, net book value, add the fair value increase of PP and CWIP. Next, I will straight away write what is my next loan? How much is my loan? 16,665. 16,665. No impact. Which one? Yeah. Your choice. I have taken what they have done in the study material. For time being, what you do, just write the fair values now. Because after this, we don't have any deferred tax impact. No? So going forward, what I want you to write, just leave the book value part, write the inventory 9,999. Because I don't need this, no impact on the deferred tax. Trade receivable 33,330. But you need this, they asked you journal entry, right? They asked you journal entry, no? If you do this, journal entry is easier. Otherwise, you will take the net assets. Again, for journal entry, you need these numbers. Yes, Prithvi, what is your doubt? You are clear now? Perfect, right? And then you have got CCE. No, we don't take over the CCE. Cash and cash equivalent not required. Specifically, they told. Otherwise, I would have taken that also. Other current assets, 16,665. Yes, we are done with all the assets. Then I will move with all the liabilities, provisions, other liability, trade payable. I will take the total fair value of the net assets. For this deferred tax liability, I am going to deduct and I am going to get the fair value of net assets. Yes, students, you can pause the video and you can complete this. It's finished, students. So this is like a Carveen, where we have got certain things in India which is not you don't find in other places. Yes, next I will do the goodwill calculation, working note number 2, goodwill calculation. Purchase consideration 1 lakh minus FVNA for my portion is 1,19,988. So you get a capital reserve 19,988. Assumed there exists evidence to take above gain to OCI. See, the moment you get the bargain gain, you will give one standard note. That means if it is capital gain on bargain purchase, assume, just make an assumption. Then we have to reevaluate that steps whether done, purchase price allocations and all. We have to tell that story. So your purchase consideration is 19,988 and a small note you will give, assume that the above value is, there is a proper evidence. Yeah, there is a proper evidence, no? Z, they said very clearly in the question, Z had got a financial difficulties. Is he in a position to negotiate with me? No, he has to just exit now. So he will sell at a throwaway price and go. So I have got an evidence that yes, I really made this. It is not a calculation mistake. I can explain it. So that's why we'll write this theory. In extremely rare circumstances, you may do this bargain gain. So if you can't find the evidence, you have to take directly in the capital reserve. But if you get this, you transfer to the OCI and from there you take to the capital reserve. Yes. So what is next? Journal entry. Yes, students. So please pause the video and pass the journal entry. So online students, please understand, this is not 103 question. This is actually 111 question. Okay, I should have put it there. In fact, initially I had put it there only, 111. Because related contents and all you can find only in 111 standard of the study material. Okay, so don't get confused. This is the way we have to account like 103. Yes, will you finish the journal entries? Yes, let us check the journal entry. Very simple. PP 1,66,000, ROU, development CWP, financial assets, inventory. These are all the values coming from your goodwill calculation. Provisions, other liabilities, trade payable, deferred tax liability, something extra. Yes, what happened? Any mistake? You said net assets. Possibly it may happen in exam also. Please be careful. That's what I was trying to tell. No, then Dhanush, you said me, can't we do this calculation in another way? Yeah, we could have done that, but we would have got caught here. And in examination, please understand. See, should you write narration? Now, how do I know? You know, in foundation level, some questions they specifically say in the examination don't need to write narration. That means if unless you come across that at the foundation level, you are expected to write narration. Otherwise, overall way they will deduct the marks. So that may happen at a final level also. When they and you expect net assets if you give one journal entry, the evaluator becomes very happy because he need not apply mind. Right? I will do like this and proceed further. They have to sit and see, what values are given, what components are given. So don't make them happy. They make them sad by making them to look what you have written. Okay, so this is the cash and cash equivalent purchase consideration. This is the, so is it very simple, correct? Yes, now please pause the video students and do what? Attempt question number 4. What is the question number 4? Prepare pre and post acquisition PI right pertaining to company Z. That means what you need to do, wait, 1 minute, there is a catch in the question. Question says, draft the balance sheet of X based on your analysis in part 1 as at acquisition date. That means what you need to do is something very simple. So I'll just show you the format. Okay, contents you don't need to change. See, you need to prepare a balance sheet. You write pre-acquisition, what was there in their balance sheet, adjustments, post-acquisition. Like this, you have to complete the balance sheet. Clear? 3 columns you have to add. It's not our traditional balance sheet, like we will have a notes to accounts and all. So they don't expect you to do that. They just want to, in one phase of the balance sheet only, write pre, whatever value is there, write the adjustment journal entries, and write the closing balance sheet. Yes, students, please pause the video and do this. Yes, students. So we can just compare the answer. You can check it. So it's a simple. Take 30th June balance sheet. You have already passed one opening entry. So add those values, get the closing values. And again, format, everything is straight away available. That means, see, if this question comes, possibly as it is, should you not attempt? No, you have to attempt it. Don't get confused. Don't get into other unnecessary headaches. Just see whether it is repeated as it is. Repeated as it is, then write the theory, what I am going to share with you. So you are going to write all these things. See, just consolidate and get one consolidated balance sheet. Similarly, you go to the equity, other equity, there is no adjustment, capital reserve will come. Alternatively, you could have added here also in other equity this adjustment, because capital reserve you don't show separately on the face of the balance sheet. Provisions, other liability, deferred tax liability will come. financial liabilities, the total work may vanish. And the last question, okay, since they have removed it from the final, your new syllabus, they have removed that. Is it a step acquisition? Your answer will be like this. Okay, as of now, you give less priority to it. As per Ind AS 103, in case of entity acquires step by step by the acquisition and the investment is accounted as per 109 or 28, you have to remeasure your previously held equity and resulting gain or loss you transfer to P&L account. This is the theory what we used to write in every place. But in the given case, since X do not have any interest in Z, you didn't acquire Z. What did you do? You acquire a participating interest of Z. So it is not a step acquisition as per 111. You cannot say step acquisition concept comes when you are holding something in Z, in their equity share capital, and you take control over Z, then you talk about step acquisition. This is like a joint operation. You are holding 30%. You take 33.33% of that 10%. So you can't treat it like a step acquisition. Step acquisition in this makes no sense at all. Step acquisition concept comes only if you take the equity interest of some entity there. Followed, no? So your concluding answer is this is not a step acquisition, if at all. Worst case scenario, if this question comes, which they have removed. So are you clear, students, about this question? Yes, very simple question. With this, we are done with the business combination. Yes, now we will move on to the common control combination before we proceed to the last aspect called reverse acquisition. So we'll try to understand what is a common control combination. It's a combination involving entities in which all the combining entities are ultimately controlled by the same party before acquisition and after acquisition of the business combination, and most importantly, the control is not transitory. It's not temporary. In reverse acquisition, what happens? The acquiree's owner will control the acquirer. In normal combination, the acquirer acquires acquiree. But in common control, before acquisition and after acquisition, both acquirer and acquiree are under the same management. So entity can be controlled by individual or group of individuals under a contractual arrangement also, and they may not be subject to Ind AS. Like when at the top, like you are asking me, who is there? There can be individuals there rather than a company itself. And there can be group of individuals who have got a common understanding, because it need not be purchased by one person. Like for example, you have got two people controlling or two families controlling this P Limited. Same two families may control S Limited. And today P acquires S. It is not an acquisition, it is a common control. Now because if I look back behind who is there, it is not one person, it is a group of people controlling here, group of people will control here. But they will have some contractual arrangements. Thus, to become a common control combination, it is not necessary that the combining entities should be included in the same CFS. That means CFS should have been prepared, they should be already part of the CFS, not required, because the moment human being comes into picture means Ind AS. So don't be under an impression that to be under a common control, the acquirer and acquiree should be falling under one CFS. It can be possible that these people are controlled by the individuals. The word transitory is included to ensure that the acquisition accounting applies to transactions that look like common control combination, but actually genuine transaction. You remember one question came. I told you we will discuss it again. For example, P Limited acquired one company called a Transit Limited on 1st April. On 1st October, Transit Limited acquired S Limited. And on 20th October, S Limited sold Transit Limited sold S Limited to P Limited. Now my only question to you, is this acquisition common combination or business acquisition? Because the structure will look like this. Previous structure was P was there, below that transit was there. Now transit took over S. New structure was like this, P, transit, S. And then transit sold this to P. The new structure started to look like this. Now what you need to tell me, this combination is a common combination or business acquisition? Then you will tell me, sir, it is a common combination. Why? Who is controlling S before acquisition? P, through this structure. Who acquired whom? P acquired S. See, don't get confused. I know, because word is like that. People have made it like this. We are not talking about this. We are not talking. Followed, no? Because transit is a fake company. Transit has got no transactions. Transit is a company, just it was incorporated. We are not talking about this. Because transit acquired S. This is a genuine business combination. Now my question is, when P Limited acquires S Limited from transit, is this business in this business combination, who is the acquirer? P. Who is the acquiree? S. Now how do you account this? Will you use pooling of interest method or you use business acquisition method? By looking at it, you say it's a pooling of interest. Why? Because before this acquisition, what was the structure? P was there, transit was there, S was there. Who was controlling S? Who was controlling T? P. So before acquisition, S was controlled by P. After acquisition, who is controlling S? Same P in a different structure. So since before acquisition and after acquisition, same ultimate party control both the combining entity, it is a common combination. Then you say, sir, for this business combination, apply pooling of interest method. But the standard says, wait, how come this transit limited came into picture? It is one transition you have taken. You simply incorporated a company to avoid purchase acquisition method. That's why standard says that you can do this, but the control should not be transited. That means in this combination, even though it looks like a common combination, when S is acquired by P, you have to acquire acquisition accounting. What is the difference? In common combination, the values are taken over at a book value. In acquisition accounting, the values of S Limited are taken at a fair value. Have you understood this? And they didn't define what is transit. Okay, that is the subject matter of an judgment. Transit limited. Normal. First of all, for transit limited, when? Before sale, no? Before sale, right? You are talking about this structure, right? Then transit limit will prepare two things called SFS and CFS. SFS is prepared as per Ind AS 27, CFS is prepared as per 103/110. Obviously, no, we took a controlling stake only, right, in S. Now, in 110, we will learn that there is one exemption. That means if you have an intermediary parent, if you get the permission from your parent not to prepare CFS, you need not prepare CFS. Why? Because your ultimate parent will prepare CFS through chain holding. In 110, we are going to work something called a chain holding. You acquired him directly and you have got a chain interest here. So we are going to work on chain holding. That's what you are going to learn. How this chain holding consolidation is going to happen. Are you clear up to here? It's not a common control. Which this one? It's a common control. No? In legally it looks like a common control, no? Because see, P acquired T, say 100%. T acquired S, which is 100%. And then T sold S interest to P. So instead of this group structure, the new structure will look like this. Previously, S was sub-subsidiary. Now, it is a subsidiary with a direct stake. Previously, in S Limited share certificate, Transit Limited name was there. Now, in S Limited share certificate, P Limited name will appear. In return for this, what P Limited gave to Transit Limited? In P Limited share certificate, previously there was name of Mr. X. Today, in P Limited, there are two names called Transit Limited and P. It is called a cross holding. With the grace of God, till now in CA final, concept of cross holding they have not discussed. Somewhere at the intermediate level you must have come across cross holding. That means parent holds in subsidiary, subsidiary holds in parent. Anyhow, don't need to bother. Why you want to get into all those things? It's only an academic thing you have to understand. So how to account it? So are you clear, Novindya? Whatever we discussed. So how to account? So we need to follow one method called pooling of interest method. Very simple method. All no headache only here. Why? All assets and liabilities at the book value. Simple. No fair value adjustments. Securities are issued at a nominal value. No, you need not consider the market price and all. Whose market price? Acquirer's market price, acquiring. So you wish every combination should have been common control. Adjustment to harmonious accounting policies will be done. Reserves will be acquired. See, when in the business combination, did you acquire reserves and surplus other equity? No. But in common combination, even your reserves and surplus will be acquired. No goodwill or calculation. No calculation only. No goodwill will be there. And the difference between the share capital of the acquiree and what shares you issued will be transferred to the capital reserve, plus or minus. Because it's common control, no? In common control, it's like an amalgamation. Their reserves will become your reserves. That means if there is a foreign currency translation reserve, if it was a business combination, okay, you will not take that foreign currency translation reserve of the subsidiary. Which one? Pre-acquisition. Post-acquisition you will take. But here, the pre-acquisition reserves also will come in my consolidated balance sheet. That's why this is a different method of accounting. And this is CAFin. It is not in your IFRS. It is done only for Indian scenarios. Have you understood this? Accounting will solve the problem. We'll understand it. Now restatement, 103 state that the common combination financial statement in respect of the prior period should be restated. Because when you give a comparative, Arey Baba, it was with you only, no. So the business, how? As if the business combination has occurred at the beginning of the preceding period, irrespective of whenever it happens. This type of things you will come across in issue of bonus shares. When you issue the bonus shares, you have to restate your EPS purpose. You have to consider your denominator as if you have issued at the last year's beginning, like a third balance sheet. So for example, I have given this. However, the business combination has occurred after that date, you should restate only from that date. Okay, what is the meaning of this? See, S1 Limited was acquired on 1st of April 1980. Somewhere in 80 they acquired. Now S1 Limited acquired S2 Limited on 1st April 2000. Okay, it's not S1, S2. Now, from when the what is it called, common control? From 1st of October 2019. Wait, something. First April 2018 and the 1st of. Okay, this is S2. Okay, it is like this. You have to read it like this. S1 was there. A parent acquired S1 on 1st April 1980, very old subsidiary, and parent acquired S2 from 1st April 2000. Both were under common control. Now S1 acquired S2. So previous structure was like this: P, S1, S2. After this acquisition, the structure will be P, S1, S2. This is the new structure. When they acquired on 1st April 19, 1st October 19. Which financial year is this? 1920. Which is my previous year? 1819. For 1920 financial year, previous year is 1819. So should I restate? Yes. From which date? 1st April 2018. Why? Because by that day already this subsidiary was within your control. That S2 was within your control. That's why you have to restate from 1st April 2018, last year's first day. Irrespective, beginning of the preceding period. Preceding period is last year. It's first day only you should start combining it, restating it. And current year, even though you acquired on the 1st October, when you prepare CFS results should come from 1st April 2019, which is very strange thing. Generally in business combination, restatement of last year doesn't happen because last year it was never your subsidiary. And this year, you will start consolidating results, operations and all only from 1st of October, when if it is a normal combination. But if it is a common control combination, when you do the consolidation, you consolidate the profits right from the beginning, even though acquisition happened at the middle of the year. Why? Because at the beginning of the year, both were under common control. Have you understood this line? P acquired S1 on 1st 1980, S2 in the year 2000. And then in 2019, S1 acquired S2. S1 was in the year 1980. This was in the year 2000. So by the time S1 acquired S2, both were under the same control. Now let us see this example. See the second example. In 1980, S1 was there, but S2 was acquired 1st October 2018 only. That means last year's half year, S2 was never part of the group. Last year's up to middle, S2 was never part of the group. They became the part of the group only middle of the last year. So in 1st year, October 2019, you acquired as normal. Which is your current financial year? 1920. Which is your last year? 1819. But will you consolidate from the beginning of the year? No. You will consolidate only from 1st October because on that day they entered your group. Because common control started from that day. Will you consolidate from 1st of the April? Yes. Because at the beginning of this year, it was already under common control. Enough. One question is there somewhere. For this, you need to understand this. CFS of CFS of the ultimate period. Because see, ultimately when you prepare a CFS, all these intermediate S1 and S2, S1 has got an exemption not to prepare. You can take that exemption. Generally, intermediate parents will not prepare because see, you prepare on CFS, one more auditor has to be appointed for that. Auditor fees has to be paid. That's why generally in this type of structure, no, they get an exemption. They take an exemption not to prepare CFS. An ultimate prepare entity will prepare CFS. Acquisition. Both will, yeah, first time both would have, P would have appointed S1 and S2 when they acquired, no? They would have purchased, they would have accounted using acquisition method only. Now when S1 acquired S2, no, now comes the common control combination. Okay, so that's it. So we'll solve some problems. You will understand and appreciate better. how the common control combinations are going to work. Yes, take out question number 32. Maxi Mini Limited has got two divisions. Okay, so this is a case of demerger. Okay, in demerger, what you do now, you take one division, you convert it as a company. Now, Maxi Mini has two divisions called a Maxi and a Mini. Yeah, please remind me to discuss some theory questions, okay, on this. Immediately after this, we will discuss the theory. We will solve the questions first. Or you want theory questions? Now, draft information of the assets and liabilities they have given on 31st October. Now, Maxi has got a PP accumulated depreciation, so net assets are so and so. The current assets accumulated depreciation they have given you. Financed by loan fund, that means they have taken one specific loan for mini division. Own funds, generally see what happens in any company. For divisions, you prepare P&L account because divisions are considered as a profit centers. Generally, for a division, nobody will prepare a balance sheet. That's why balance sheet is prepared for a company as a whole. That's why you may not find the breakup of equity capital, meaningless. No? Divisions who will prepare? P&L account you will prepare for divisions. Sorry? It's like a segment. Yeah, divisions are like segments. Now, other equity also you don't have any breakup. So that's why they gave you a question mark here. That means not applicable. You may have assets and liabilities you may have tagged. But the equity and other equity you cannot do the breakup division wise. So total. Now it is decided to form a new company called a Mini Limited to take over the assets of Mini division. So this is a demerger. Accordingly, Mini Limited was incorporated to take over the balance sheet figures of assets and liabilities because it is a common control. No? Mini Limited is to allot 5 crore equity shares of 10 each to the members of Maxi Mini Limited in full settlement of the consideration. So the new company which got incorporated, they took over the assets. Now see, this time, for the first time, entries will appear in the books of Maxi Mini Limited. Generally, in the books of acquiry, entries will not happen. But now the entries are going to happen because when the demerger happens, assets will really go out of your business. In business acquisition, assets will not go. You will continue doing your business. But from the balance sheet of Maxi Mini Limited, the assets of Mini Limited will go off. Then it is a loss to the shareholders. That's why the Mini Limited now, not division, will issue its shares to the owners of Maxi Mini in the same proportion in which they were holding earlier. Therefore, Maxi Mini Limited, therefore Mini Limited members, Maxi Mini Limited owners becomes a Mini Limited owner. So it is just a demerger asset. There is nothing, no difference. Previously, there was one division. You converted that division into a company. Who was the owner of the division? Maxi Mini Limited shareholders. Now, who is the owner of the Mini Limited? The same shareholders of Maxi Mini Limited. In which proportion? In the proportion they were holding earlier. So, somebody is holding 5 shares. They would have got 1 share proportionately. Somebody is holding 500 shares. They would have got 50 shares. So, for them, it doesn't make any difference. Only the balance sheet got restructured. Okay, so this is a common control combination. This is like a traps. Institute will set different traps. Okay, we should not fall into the trap. Now you are asked to pass the journal entries in the above book because this is that information that members are becoming the members without having to make any further investment. That is the business combination. Show the balance sheet of both the companies on 1st of November showing corresponding previous year figures. The directors of 2 companies asked to find out the net asset value. This is purely AFM calculation. What was your net asset value before and afterwards? And comment on the impact on the wealth. You say no impact. Okay, write solution. We'll solve this. Okay, before we solve, why do they do such transactions, students? Can they fool people? Okay. See, Maximini Limited had a loan of rupees 100. This loan was specifically taken to a loss-making company, loss-making division called Mini Limited. After you took loan, now what happened? After you took loan, you started one division called Mini Limited. Mini Limited started to make loss. Who has to repay this loan? Maximini Limited. See, Maximini Limited took a loan and they used this money to start one new division called Mini Division. To their bad luck, the Mini Division started to make loss. Who has to repay this loan? Maximini Limited shareholders have to repay. Now they transferred and created a new company called a Mini Limited. This loan also went to that company, which is a loss-making company. Who has to repay the loan now? Mini Limited. The liability of the shareholders are limited there. But if Maximini Limited is a profitable company, Baba, understand? Today, Maximini Limited is a profit-making company. When this money is repaid by this profit-making company, your net assets of Maximini has come down. You transfer this loan to this Mini, which is already having no cash flows there. Now, who is at stake now? Who will cry? The lender will cry there. Lender will cry, no? Whom will go now? He will go to first Mini Limited. Mini Limited will show its zero bank balance. Immediately it will go to the shareholders of Mini Limited. Mini Limited shareholders say, sir, Baba, my liability is limited. Whatever I contributed is contributed. Now, literally, is that concern in a soup? That's why we should understand the laws. Legally, it is permitted. That's why demerger and all goes through court. In court, they will call who are your creditors, is it okay to them, how you plan to repay. So restructuring doesn't happen just like that. Followed, no? It's very interesting, huh? Because people will fool others like this. Your money, our money, their money gone. Somebody's money, somebody sitting in Switzerland there. And this bank is prepared one note and written it off as an NPA. Why so much restructuring happened here? That's why students see outside, so many manipulations do happen. We are not exposed to it. But this is all the tools which was not there 100 years back. Now it is there. That's why world has become more complex because of this type of structures. Anyhow, just to tell you some ideas, what restructuring, how somebody can use to make money. Okay, first they asked me the journal entries. So we can write here, demerged company is Mini division of Maximini, resulting company is a Mini Limited. Need not write also, it's okay, you have to write. So they asked us to pass the journal entry and prepare the opening balance sheet. Journal entry in whose books I need to pass? Both. Generally, they will not ask me in the acquirees book. But here in the acquirees book also it has been asked. Okay, right? A, journal entries in Max Mini Limited. Can you tell me, students, what entries I should pass? This transaction happens between Mini Limited and the owners of Maximini Limited. Does Maximini has to do anything here? Yes. Some assets sitting in their balance sheet will move out. No. So, loan account debit, because loan is no more my loan now. You see how beautifully they are shifting this loan to another company, that to another limited company. Current liability account debit. 100. Accumulated depreciation account debit, 100. Is there anything else on the liability side of the balance sheet which is related to mini division? Because mini division related assets and liabilities will go off. No. Which one? Other equity is not allotted to mini division. So that is belongs to company as a whole. Only assets and liabilities will go from one division and it will become a company on its own. Do you have any liabilities other than these three? No. So write loss on restructuring. Keep it because it's the balancing figure. Or we don't know. There can be gain on restructuring also. We don't know. Since I am telling you, please write it. Otherwise, you will be left with one space there. 2 PP. How much? 300, because all things goes at a book value. You cannot take it a fair value. 2 current assets, 300. So the differential figure will go into loss on reconstruction. So Maximini is going to pass this accounting entry. Why? Because certain assets and liability will go. Corresponding purchase consideration doesn't come to you. So when the assets and liabilities will go off, it's not a business combination for you. What came to you? Nothing. So for me, it is a loss on restructuring. So what should I do for this? Should I take to P&L account or balance sheet? Depending upon what your loss is. Because this is routed through a court. So court may suggest an accounting for this. That accounting may not be acceptable to you. Then this becomes, in audit language, this becomes a framework which is not acceptable to an auditor. There is one question. If the framework is not acceptable to you as an auditor, what you will do? Okay, I'm telling you. So I'm just giving an example that this, when the court tells you certain accounting, do it like this, do it like that, it may not be acceptable to you, but you have to just comply. Okay, now we will prepare the balance sheet of Maximini Limited. Very simple. First I start with the assets, non-current assets. Under non-current assets, I have got PPE. How much? I'll give note number 2. I'm going to prepare 2 notes. Note number 1 is other equity. Note number 2 is PPE. It is on 1st of November, it is 100. What was there just one day before? 200. Look, 300, sorry. Look at the balance sheet, no. Look at the total, because see, Maximini Limited, just one day before, that is 30th October, it was having 2 divisions. This is after restructuring, this is before restructuring. This, yeah, we can say WDV. 1 minute. Yeah, presentation wise, I think you can do it 600 minus 500, or we'll simply consider 100. Otherwise, if you want, you can say gross block 600 minus accumulated depreciation 500, which is 100. I think this is going to come in your, not on the face, Baba. It will come in your notes to accounts. Yeah, it will come in the notes to accounts. Huh? Your question is very valid. So here when you said 100, where is gross block? That's why we gave one note. In note, I will tell that gross block is 600 minus accumulated depreciation is 300. Are you clear? Then we have got current assets. Under current assets, other current assets. How much today? 400. What was there before? 700. You're clear, no? Yes, we got the total of the balance sheet, which is 500 and 1000. Yes, we have got only two items, PP and other characters. Yes, now we will move on to the equity. Equity share capital, how much? 50. Before 50, because it's one division went out. No, your company's Maximini Limited company share capital didn't change. Mini Limited paid its share capital to the owners of Maximini Limited for whatever assets and liabilities taken over. So there was one company called the Max Min Limited. It had two divisions called the Max and Min. Now Min Limited came, took over your assets, didn't pay you anything. Instead, they paid their shares to the owners of this. They gave their shares to the owners in return for the assets and liabilities of this Max Mini division. We are doing Maxi Mini now. We are in the books of Maxi Mini now. We are not in the books of Mini. Mini also we have to do now. Mini will get assets in return for, because for them it's like a business combination. Where they don't have? They have no. They have given their equity shares to the owners of Maximini Limited. It's like a notional only as such, because previously some assets were there in the balance sheet of Maximini Limited. Now the same assets will appear in the balance sheet of Mini Limited. So, see, are you very clear about the structure, Baba? Understood what happened? See, previously there was only one balance sheet called Max Min Limited. This Max Min Limited has got two divisions called Max and Min, but there were no two balance sheets. There was only one balance sheet. Now what did you do? You split this and created one Min Limited balance sheet. But the moment you create one balance sheet, something goes out of one legal company, simply we cannot permit that. No. That's what I told you. Somebody can fool that. So we went to the court. Court approved. Then these assets will go here in balance sheet. What did this company got? They didn't get anything. If they would have got something, okay, their bank balance would have got increased, or in the Mini Limited share certificate, Max Mini Limited name would have been there. They didn't get anything, no. That's why they treated this as a loss on restructuring. But ultimately, who incurred this loss? The owner of Max Min. Because Max Min, does it have any feeling? Does it feel bad? No. Who will feel bad? The owners will feel bad because they are human beings. How they are compensated? The new balance sheet what is prepared, in their balance sheet, they have also got a share capital. That share capital was issued to this owner. So for this owner, it doesn't make any difference. Certain assets was previously there in this balance sheet. Now it has moved into this balance sheet. But for company, it will make difference. Previously, this asset was here. I am going to remove it. And it is no more with me. There is one new company coming into picture who don't have any cash only. They got simply some asset in return for the shares given as a consideration. Instead of who invested on whom? Now tell me how the structure will look like now. There is one guy, this guy has invested in Max Mini and this guy has invested in Mini. Now tell me, what is the relationship between Max Mini and Mini? Is Max Mini parent of Mini? No, that's what I'm telling you. No, in Mini's share certificate, Max Mini name is not there. If Mini's certificate, Max Mini name would have been there, then we would have said, yes, Max Mini is the parent of Mini Limited. That is an investment done in the subsidiary. What goes out is the investment done, not loss on restructuring. If the Max Mini's share certificate, Mini certificate, Max Mini name would have been there. But today, Mr. X name is there, no. Something went out of a legal company, but that legal company didn't get anything written. Ulta, that legal company's owner got share certificate of some other company. Have you got this structure, right? That's why these people, there is no parent subsidiary relationship between Max Mini and Mini. Is it common control? Yes. If I look into these two companies, who was owning them before? X. Who is owning after? X. That's why it's common. That's why assets and liabilities I have to take over at a book value. No goodwill comes into picture here. Since anyhow it is a division, their reserves are not there. That's fine. So X, that's what X doesn't make any difference. All the difference makes to this company. Because certain assets goes, nothing comes back to them. This company is enjoying. Assets comes into this balance sheet. In return, they didn't pay any cash. They issued their share capital. But nothing happens because ultimately X is doing. Instead, if they would have created this company and they created in their share certificate, if they would have written Nagabhushan Pai, this person would have really cried and I would have been very happy. Correct, no? Because I got physical assets in return for share certificates. In whose name? In my name only. That means I got a gift. So the structure can be like this. And this could have been gone to one trust there. The trust could have been located in Mauritius. So in audit language, you call it transaction outside normal course of business. A very complex transaction created which somebody will not understand so easily. Then how do you account, Baba? And previously that challenge was there. Now there is no challenge. Now in days, no, we will tighten the screw now. We will understand layer after layer what happened, who is their person behind it, which was not possible previously with the accounting standard. Accounting standard was fractured, broken. Index is very strong. You could feel now. Okay, are you clear now, this structure? Yes, so now we will move further. Equity share capital will remain same only. Other equity, write note number 1. Okay, we have to work out now other equity balance. You write 350, 650. I should have done this other equity balance first. Anyhow, leave it. Just for time being, you write now 350. And what was that before restructuring? 650 for company as a whole. And you can expect this question in the examination as it is. Yes. Why? Because understanding as it is itself is tricky there. Then you have got non-current liabilities, loan fund. Previously it was there. Now in the new balance sheet not there. Why? Because this has been gifted to Mini Limited. And you have got current liabilities, which was 200 earlier and 100 to you. Finish your balance sheet. So simple question, no? Simple, right? Everything? No, clear? Are you very clear? Everything, what we are doing, why we are doing? Yes, below this write notes to accounts. One, we wrote no other equity. Because we wrote note number 1. How much is my other equity right now? 650. 650. Is there any adjustment to it? There is a less loss on restructuring 300 because I gave back my net assets. In return, I didn't get anything. So 350, 650. Second, you asked me about this PP. What is my gross block? Previously, it was 600, 900. Minus accumulated depreciation, it was 500, 600. So I have got a net asset of 100, 300, which I'll show on the face of the balance sheet. There I don't show as a gross block, net block. Why? Schedule 3 has told me. Schedule 3 also tells don't show on the face of the balance sheet. Show as a note to accounts. So are you clear? First we passed one journal entry for demerger where certain assets took over, but there was no corresponding what is that called in purchase consideration. So the acquiree transferred it to the loss to the reconstruction, and they simply prepared the balance sheet prior and after without this. So now you need to explain notes to accounts. You have to explain somebody what somebody will understand. Consequent to restructuring, the division Mini Limited is transferred to Mini division is transferred to Mini Limited against shares, 5 crore shares, Mini Limited to members of company. See, very clearly you are explaining someone, look, during the year restructuring happened. Due to this restructuring, there is one division with us called mini division. This was given to one company called Mini Limited against 5 crore shares, which we didn't receive, which was given to the members of our company. Since both are under common control, accounting is done at book value. Since both were like Mini Division, Mini Limited, Maxi Mini Limited are under common control before restructuring, after restructuring, the accounting is done under the book value. Yes, with this, we are done with the balance sheet of Maxi Mini Limited, who is the acquiring. Then they asked us, pass the journal entry in the books of Mini Limited along with the notes to accounts, along with the balance sheet. Okay, what is my journal entry? Okay, are you done? What is my journal entry? Write B, journal entry in Mini Limited. This is now very easy because Mini is an acquirer. PP account debit, how much? $200. See, Mini Limited will not acquire your accumulated depreciation. He will acquire net book value. From now, the new journey is going to begin with the accumulated depreciation. You have taken current assets. How much? 300. That's it. These are the only two assets you got, right? To loan, 100. To current liability, 100. Then to equity share capital, how much? 50. 5 crore shares at 10 rupees. Then to capital reserve, balancing figure 250. Means it's a gain for you. How it is possible, Baba? For him 300 is the loss. For how it is 250 is the gain? Because when I took over this, okay, I got 300 rupees worth of net assets. For this, I gave purchase consideration of 50. Whom? To the shareholders of Maxi Mini Limited. Understood, no? Okay, now I have to prepare the balance sheet. This is my journal entry. Now I have to prepare the balance sheet of Mini Limited. PP is on this is a very simple thing. Only one journal entry I have to plot. So I will say PP is 200, current assets is 300, equity share capital is 50, other equity is 250, loan is 100, current liability is 100. Very simple, no? But notes to accounts I said, because you are an acquirer now. You said 50. Did you receive money? No, you have to write there. It is made up of 5 crore shares of 10 rupees. All the above shares are issued for a consideration other than cash on account of pursuant to demerger, blah, 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 as per court notice number, court order number, so and so. A very detailed disclosure has to be given for this 50 rupees. Are you clear? Yeah, you can just write short thing. Now you need to write a notes to accounts where you say that one share capital issued and paid up 5 crore shares of 10 each. All the shares are issued for consideration other than cash. As per section 143 subsection 1, auditor has to make inquiry. In inter it was there, no, for you, on 6 to 7 aspects. One of the aspects is, have you issued shares for consideration other than, this is that instance. And if yes, has it been accounted properly? Then you have to see the accounting. You should not misguide someone there. Proper disclosure should have been given. Otherwise, if you don't give this disclosure, no, somebody will not understand what happened here. How did you get these assets just by issuing shares? Who gave? If that is the case, I will also take, no, all the assets by, I will create a company, Nagabhushan Pai and Co. Limited. Let everybody give their assets to me. I will issue my shares to them. That way it doesn't work. If that happened, that means some restructuring must have happened. Okay, are you clear? Yes, we are done with this. Now we will take the pre and post merger net assets. What is net asset value of Maximini Limited before merger, after merger? Can you tell me the net assets before merger? Look at the balance sheet. Before merger, what is the net assets of Maximini Limited? 700. Just look at equity share capital plus reserve, no? Divided by how many number of shareholders? 5. So share price, net asset value is 140. Post acquisition, what is their net assets? Post demerger. This you will not find. You can find in your balance sheet only. You are working only. You have created a balance sheet, no? 2 comparative balance sheet. How much? In fact, I can go back here. Maximini Limited balance sheet. What is my net asset? Net asset is 400, 700. So 400 divided by how many number of shareholders? 5. So it is 80. That means your net asset per share has come down. What is Mini Limited's net assets before merger? Nil. Because it was never existing only before demerger. Post demerger, what is their net assets? 300. How do you get? Look at their balance sheet, no? Just now you created. Divided by how many number of shareholders? 5. How much it comes to? 60. So you add both pre-acquisition net asset value per share and post-acquisition net asset value per share is one and the same. Are you clear? Okay. So what is the impact? See, impact, no impact. on demerger. You say there is no impact on account of demerger because your net asset value is before also 140, after also it is 140. And these questions also have come for the exam, which you are supposed to solve it. Yes. So next question, which is very similar to this. Okay, two questions I will solve. Rest exam questions you may have to solve it. Enterprise Limited has got two divisions called laptop and mobile division. Division laptop has been making constant profits while mobile is making losses. Now 31st March, division wise draft balance sheets were given. PP they have given you depreciation, accumulated depreciation, current assets, net of current liabilities. Financed by loan fund, that means they have got a specific loan for mobile division. Equity capital they have shown only for, but they need not show it, Baba. Understand, this breakup is confusing breakup. Don't go with this breakup. Because generally nobody will prepare a balance sheet for divisions. So this breakup, no 175 and minus 100, it may be confusing. You just look at the total. Division Mobile along with the assets were sold to 25 crores to Turnaround Limited, who allotted 1 crore equity shares of 10 each at a premium of 15. So this time, previous question, when you passed the mini limited account, no, you told share capital, full 5 crore, 50 crores. But here, when you say Mobile Limited or say Turnaround Limited, you have to split that, share capital, share premium. Full settlement. One of the members of the Enterprise Limited was holding 52% shareholding of the company. That means this must have happened in proportionate. So going forward also you will hold 52% because you have given in a proportion. That means it is a common combination. Pass the journal entries in the books of Enterprise Limited. Prepare the balance sheet of Enterprise Limited after this. And prepare the balance sheet of Turnaround. This time they didn't ask you the journal entry in the books of Turnaround. Simply straight away they prepare the balance sheet. Same like previous question. Exactly same. Okay, let us pass the journal entry. In the examination, they may ask you prepare as per Schedule 3 format along with the notes to accounts. No opening journal entries asked for the turnaround. If you want, you can just pass that. And one more thing you have to remember, no balance sheet is prepared for the division. See, looking at this losses may create a confusion. So what I am trying to tell, just ignore these numbers what is appearing there. Otherwise you will get confused. Just look at the total here. It's very plain and simple like previous question. The moment you start looking at the internal numbers there, later part you will feel you get confused. Okay, so start solution. Journal entries. They simply said journal entry. So this here is not required, demerger and all. Book value will take and all not required. Straight away will write journal entry in the enterprise. Can you suggest me, students? Loan account debit. How much? 300. Current liability. Accumulated depreciation will not be there. Yeah, provision for depreciation is there, 400 and accumulated depreciation 400 because all this will go off. Sorry. No, because today's day in your financial statement, when you charge depreciation, what accounting entry you pass? Depreciation to accumulated depreciation. There is one ledger account called accumulated depreciation. While presenting that accumulated depreciation, you will show it as a deduction from the asset. But that ledger is still there. No, should you not close the ledger? So you close the ledger by debiting it because already it has got a credit balance. Understood? Because financial statement is the summary of that ledgers. There's one already a ledger called accumulated depreciation. So you have to close that. But when the new company turnaround comes, it will not create one account called accumulated depreciation. Not required. It will create, and from now onwards it will charge. In enterprise limited. So that person automatically will become 52% shareholder of, okay, it's like this. You have got enterprise limited, you have got turnaround. There was two laptop division, mobile division. 52% was held by say X and balance 48% was held by so many people. Now when this mobile division was given to turnaround gave its share capital to two set of people. 52% is held by X, balance 48% is held by so many people. Is it a common control? Yes, because enterprise and turnover before control was controlled by X, and after acquisition also they are controlled by X. That's the meaning of that sentence. That's why it's common control combination. Because both were controlled by the same people. Because in demerger, there are different schemes of demerger. One of the schemes of demerger, it can be possible, see here, they may give their share capital to Mr. Z. How much? 60%. And 40% X will hold. Now this will change every situation. This will become normal business combination. Because your owners of enterprise and turnover before and after are different. It's not common combination. Now you have to take over at a fair value. Because it was held by same X, you are taking over at a book value. Understood the difference? Why they give that sentence? Followed, no? Yes. So journal entries, I think you must have passed. PP to current assets. What's the difference? Profit. You say gain on restructuring, or you can also call it capital reserve. How on earth you got a gain? Because your net assets are negative. That's what that 100 rupees they have shown, no, net assets reserve. We will not, we will keep it in our balance sheet. And this capital reserve, we are going to touch as per the court orders. That's why certain things, no, when you learn accounting, you have to learn company laws. Certain things they will tell you which you can use for dividend, which you cannot use for. You have learned at the intermediate level. Because certain things we do as per like dividend equalization reserve, debenture reserve. We have to do certain things as per certain legal framework. Now we have to prepare the balance sheet of enterprise after restructuring. Do we need to give a comparative? No. Nice. So what is my PPE? Of enterprise limited? $25. Because other assets went off, no. So if you want to give the gross and whatever, if you want to give a note, write there at the note, gross block is so much, net block is so much. Do you have got current assets? How much? 200. Do you have got equity share capital? How much? 25. Before also, after also. Because for you it didn't change. You didn't issue anything there. Other equity? Yes, you can give note number 1. Can you tell me the amount before we do? 175. That's why I tell you, please don't look at the in between numbers. When you look at the outside, no, you will understand. It's 175. How did you get 175? How much enterprise limited had? 75 net. And the capital reserve on restructuring came 100. Followed, no? And the last one, current liabilities 25. So you have got 225. Are you very clear, students? Perfect, no? Both the questions you have understood. Both the questions are in two similar but little different here and there. Prepare notes to accounts, equity, not required, other equity, because equity didn't change, no. Turnaround should write all the story in pursuant of demerger, we have issued so members and all. You write here other equity surplus is 175 minus 175, which is sitting in the balance sheet. Or you don't write only, you just look at the outside. That's what I told you. Don't look into the inside numbers there, because balance sheet is not prepared for divisions. For a company as a whole, what is your other equity? 75, no. Look at the question. How much gain you got on restructuring? 100. 175. See, the difference between this and previously, somebody took over my net assets, which was a positive value, and they didn't pay me anything. In this question, somebody took over my net assets, which is a negative value. I should have paid, I didn't pay anything for taking over my net liability. That's why I made a profit. In notes to accounts, write notes to accounts. Demerger of mobile division notes. Okay, simply write one sentence, because you have to use this language here. Consequent upon the transfer of the division of the mobile to a newly company called a turnover, the members of the company have been allotted 1 crore shares of 10 each at a premium of 15 per share in full and final settlement in their proportion of the shareholder. This is a complete balance sheet of the enterprise limited, where you started with the journal entry, because they asked you journal entry. You prepared the balance sheet, no comparative they asked you. You give only one notes to accounts for other equity, because other items are plain and simple. And then you said notes to accounts, you explained that yes, there is a demerger happened, because of which certain divisional assets of the divisions were taken over. We didn't get the shares, but our members got the shares. Yes, doubts? That net assets is that negative balance, no? If you see the net assets, what is the net assets? 300 plus, yeah. What happened? No share accounts? Oh, no, I didn't get you. What is that note share accounts? No, sorry, I didn't understand your question. Yeah, you can write. See, for time being, but in examination, write as if, see, what you are trying to tell? Some assets went out due to demerger, and our members are given the shares. That's the crux of the sentence. You write in your own language, no problem, but that should reflect there in the notion. You have to explain that there is a demerger act. If you tell that also, fine. I don't think so it will go that much detail. Okay, now coming to your question, see, 300 plus 400 plus 400, total liability went 1100 minus 500 minus 500. 100 is the net loss, no. So when somebody takes over your net loss, you should have paid them. So that itself is your gain. That's what I am telling. Don't look at what is appearing in the balance sheet. You may get confused. Look at the total only. Previous question, you didn't ask me these questions. That's why in should you know what is this. This question is illustration 36 and the previous question is illustration 37. Confusing question comes first. I shifted that structure. Now, can you write the balance sheet of the turnover acquirer? They didn't ask journal entry, no? Yeah, please pause the video and prepare this balance sheet of the turnaround. Yes, sure. So we'll check the answers first. See, first they didn't ask you journal entry. Please understand, very smart ICI. But without this, no, it becomes very difficult to prepare the balance sheet. Now my PP comes 100 only because we discussed that accumulated depreciation will not take. I'm a new company there. Current assets 500, you keep it for time being. Loan 300, current liability 400, equity share capital is 10 at a face value. Securities premium is 15. So we get a negative balance of debit balance of 125. Since it is the common control combination, if it was not, I would have taken it as a goodwill. So I have to debit it to the capital reserve with a negative value. And how did I get this? How did I get this? See, first of all, I took over negative net assets of 100 from them, for whom they should have paid me. On top of it, 15 plus 10 I only paid. That's why I got a loss of 125 when they made a profit of 100. In the previous question, it was 300, 250. In this question, it is 100, 125. It is not equal because I paid a consideration also. So if I go to the balance sheet, PP is 100, other current assets is 150, equity share capital is 10. Other equity will have 110. How? What all those? Share premium plus your capital reserve will get offset, loan funds and current liabilities 300, 400, 600. Now we will need to go for an equity share capital because that other than cash, some story we have to write. This is very important. May fetch you 1 mark. And then other equity, securities premium and the capital reserve will get offset and you will get 110. Clear? Easy? That's it. Hardly 2-3 questions are there. They have given some notes that since both the companies are under common control, assets and liabilities are taken over at a book value, identity of the reserves are maintained, no goodwill, securities issued at a nominal value. Just leave it. If somebody is not written also, I'm okay. Unless if they ask you working notes, then you have to write this working notes, your assumptions or whatever. Yes, students. So this question came in your May 18 examination. Motorola division, constant making profits. And if you see here, which question came? The first question came where they showed this breakup. That second question what we solved, which is a bit confusing thing as compared to the first question. First question was fairly simple. Now division bay, all stories they said same, that one member 52% story also came there. Past journal entry in the books of Motorola, prepare opening balance sheet of Motorola and prepare balance sheet of Lenovo. Okay. What is the twist here? Balance sheet prepared for 1 and 2 here should comply with the relevant Ind AS and Schedule 3 of the Companies Act. That means when you tell me the notes, you should have the notes to accounts, which we generally give that. For other equity, and we have not given the notes pursuant to this. We have done in the previous question. We have done this. This notes to account they are expecting. PP, this is not because there is nothing. No. Provide notes to accounts of for other equity in case of 2 and share capital in case of 3 only. That means when you are preparing as per Schedule 3, you need not give PP, this, that and all, everything. There you give only for other equity because you have to write the story there. And share capital, there also you have to write the story pursuant to the demerger, we have issued the shares to the members. That's why I write only that much. Yes, friends, so please pause the video and do this working. Full, I want full, as if you are writing in the examination. We'll compare. Generally, what they asked only we'll do. Okay, so first thing, this is the demerger, even though you have not written this, fine. So you will take over the book value and all, not required. They asked you the journal entry. Journal entry will be loan account debit, current liabilities, provision for depreciation 800, PP 1000, current assets, and the differential amount of 200 will go to capital reserve. Okay, no mistakes. Then you will prepare the balance sheet of enterprise limited. So PP will be 50 net, other current assets 400, equity share capital same remain 50, other equity you have got the previous equity with this capital reserve adjustment, current liabilities 50. It should not take much time to solve this problem. Notes to accounts, they said you give me only for other equity, not required anything else. So surplus 150, capital reserve on reconstruction is 200, so 350. Now notes to accounts, you have to tell that on account of transfer, so much demerger happened, so and so, so and so. Now they asked you turn around, but we will pass the journal entry for our understanding sake. We get a capital reserve of 250 here. Equity share capital and share premium are 20 and 30. This is only for our understanding. Even though you are not done, I am okay. But I am interested to know that you have recorded PP at 200, other current assets at 1000. You have to give notes to accounts for the share capital, they said 20, other equity is 220. loan 600 and 800 current liabilities. So how did you get this 220? Securities premium 30 got adjusted with the 250 capital reserve, which if you would have passed journal entry, you would have understood. Alternatively, securities issued debit 50 and net assets negative 200. This becomes your 250. If you just want to use a calculator and calculate. Yes, that's it. So this is all about your combination. There are some theory questions. Reverse acquisition we will see tomorrow, which can be possible and which is nice questions also, which can be possible in your exam. Yes, see now you understand these theories. See, this question came in your RTP, so probability wise I will give you less weightage for this when you practice also. I don't give much importance because it's not a test your knowledge question. It's some RTP question of November 18. In fact, in old syllabus only it never came in the exam. Smart Technologies is a company incorporated in India in 1998, having some software development and etc. One of the leading brands, some story. So there is one company called Smart Incorporation. After witnessing immense success, Smart Technologies grew by further acquiring CloudTrees and Microfly. Smart Technologies is one technology company, software company. To have a growth, they acquired two more companies called CloudTrees and Microfly. CloudTrees is in cloud computing. Microfly is under mouse, keyboard, etc. Somewhere they found one synergy. Again, up to here story. Now okay, so the structure will be Smart Tree, CloudTree, Microfly. When in 1990s, the Smart Technologies started preparing its financial statement on Ind AS from 1st April 2015. Microfly Limited planning to merge the business of CloudTrees India Private Limited with its own, which is presented before the member. That means this company wanted to take over this CloudTrees, so that there is a structure like Smart Flow Micro. That's it. It want to merge itself into the business. Below this you may not find anything there. It's a merger case. So for which it presented before its members in the meeting below extract of the latest audited balance sheet of CloudTrees based on the Ind AS. So their Ind AS financial statements extract was presented who Microfly in front of their owners. They said that look, the CloudTrees has got a PP of 15, trade receivable, cash balance so much, other current assets, their equity share capital is 45, reserves and surplus, they have losses, and financial borrowing and current liabilities. The tax loss carry forward by the company is 27.2, okay, to be removed, okay. This to be removed means, I think this is, they have removed it from the new syllabus material or something. Anyhow, not relevant now, it's not part of your study material question also. I don't know why I have written this to be removed. Or it sounds like your book loss is 24.8, your tax loss is 27.2, on which deferred tax asset may come if you merge. On September 5, 2017, the merger got approval of the directors. The purchase consideration payable by Microfly to CloudTrees was fixed at 18 crores, payable in cash, and that the Microfly take over all the assets and liabilities of the CloudTrees Industries. Now what you need to do, present the statement showing calculation of assets and liabilities taken over. Also mention the accounting of difference between consideration and the liabilities taken over. So what did you take over? You took over net assets like this. So you have to prepare a statement. At what value you will take over? Why? Because it is under common control. Since it is under common control, why? Because who was controlling CloudTree? Smartfly. Who is controlling Microfly? Smartfly. So both before merger and after merger, ultimate parent is the same. That's why this particular combination has to happen based on your common control combination. And what did they ask? They said prepare the statement of assets and liabilities. So you should explain that. See, this is a control is not transitory and it is a common control combination. So we are going to follow pooling of interest method. They said prepare a statement of assets. No, you say assets taken over so many things, liabilities taken over so many things. So net asset is 20.2. So if you have to pass the journal entry, you would have passed the entry PP account debit, cash account debit, current assets, whatever it is. To share capital, to cash, because this acquisition has happened not by issue of shares. What is the difference between assets taken over and the purchase consideration? That's the second question here. Also mention the accounting of the difference. If I would have passed one accounting entry, I would have debited all these net assets, 20.2, credited to cash. Difference what I would have done? Sorry? Gain, where I will take? Capital reserve. So you say that the difference will go to the capital. Easy question, right? Since it is a common control transfer, you will take it to the capital reserve. As the probability of this question is very low. If it comes, feel very happy. Immediately prepare one statement of assets and pass one journal entry not required. You have to say the accounting difference I will take to capital reserve. ABC Limited and XYZ are owned by 4 shareholders. So your ABC is like this, XYZ is like this. Each of them hold 25, 25, 25, 25. Shareholders of BCD have entered into an agreement, somebody called, for governance of ABC and XYZ. Oh, that means, is it a joint operation? No. Here 3 shareholders have got an agreement to jointly control this. That means any activity requires a unanimous consent. Determine whether ABC and XYZ are under common control. Yes, answer is yes. Why? Because people who control as an individual shareholders or a group of shareholders do control XYZ. So 103 says that a common combination comes when all the combining entries, if there is a combination, all the combining entries are controlled by the same party, and that party can be an individual person or a group of individual person who have got a contractual arrangement. There should be some contractual arrangement, otherwise it is very difficult to tell. So it is not necessary that it should be included as part of the same consolidated balance sheets. CFS is not required. Nobody is preparing CFS here. Is anybody preparing CFS? No, because all these people are individuals. And ABC and XYZ are not related to each other just because under CFS, they are related parties. In days 24 we will discuss how they are related, but they are not part of one CFS. Not required. So group of individuals will have collectively have the power. So power is not transitory. Yes, it is under the common control. Have you understood why they are common control? Next, ABC and XYZ are owned by 4 shareholders BCD, each of whom hold 25%. However, there is no agreement between any of the shareholders for whom they are going to vote jointly, whether they are under common control. Same story. The difference between this story and this story, there is a contractual agreement on their voting rights. That means they are governed by that contractual. Tomorrow you cannot turn back, you not put reverse gear there. All of them make one joint decision for whatever resolution they are going to pass. Followed, no? Maybe for how they will account now. Who is controlling ABC? Who is controlling ABC? So for BCD, it is a joint arrangement. It is not a subsidiary. What for E? He is a party to the joint arrangement. You remember one example we discussed. Okay. So now question here, if there is no contractual arrangement, if all these four people are independent, God knows who is taking decision in this company. But you cannot say that there is a, since there is no contract, again you will write the same story as at the top. Since there is no contractual arrangement between these four people, you cannot treat them as a common control. So if you have to treat them as a common control, there should be a contractual arrangement between the individual shareholders. Otherwise they are independent. No, each person is independent here. They can take their own decision. But in the previous case, no, both were governed by the same set of people as a group who will take the common decision there. Here, decision can be independently taken. What decision happens for ABC need not happen for XYZ. Because two people can be party to take decision here, two people can be party to take decision here, or any combination can work out. Followed, no? Theoretical, probability of examination question is very low in this. ABC had a subsidiary named X, which was acquired on 1st of April 2010. ABC acquires all the shares on 1st April 2017. Now ABC transfers Y limited to X on 2nd April. 1st April you took and 2nd April you gave back to your parent. How should the above transfer should be accounted? Say for example, before on 1st April 2010 ABC acquired X limited. Is there any problem there? No, it is a what X limited? They incorporated. So X limited has got nothing in the balance sheet. Now immediately, intermediately, ABC limited acquired Y limited also. A structure came like this. And then they transferred Y limited back to X limited immediately for the next day. So X and Y form part like this. Now what they are asking, how should the above transfer of Y limited to X limited should be accounted? Is it a pooling of interest method or it is acquisition method? Why? Control is transitory control. That means Y is some independent party, Baba. God knows who was controlling Y. Now you, ABC, acquired them and transferred them to X limited. It is equivalent to X itself could have acquired, no? So there is a transitory control. It should not, if you want to say common control, it should not be transitory. Transitory is not defined. So you have to look into the substantive business transaction, why they did it, what happened within that one day. So many factors you have to consider. So in the given case, intermittent step of X, A acquiring Y was not required. So X limited should account of Y using acquisition accounting simply by placing X limited and Y limited under common control. You can't achieve anything. That means ABC acquire Y and give it to X. No, it's a meaningless, futile exercise. You can do it for your legal purpose, but from an accounting point of view, this exercise will not yield you anything. Why? Because X is going to follow acquisition accounting for XY limited. Have you understood this? Any doubts? Yes, Vindhya? Clear, no? Darshi? Yeah, this is that restatement. One example we discussed. I took it from here only. How the financial statement will be restated. Again, it is an illustration question. That's why I am discussing this. XYZ acquired PQR in 2009. The year end of XYZ Limited is 31st March. Both XYZ and PQR have been controlled since 1980s. Second, ABC acquired DF in a common combination on 1st October. ABC's 31st March, ABC and DF were controlled by A. A made investment in 1st October 2018 only. Second scenario. I give an example now. So if you have to say that in scenario 1, you have to restate the comparative from full year, 1st April 2018, and this year transaction you should include from April to 30th September. Full transaction you need to include. But in the second scenario, you have to restate the comparative only from 1st April to October. Before 1st of October, you are that DEF was never part of the group, and during the year from 1st April to 30th September, you will consolidate. Because last year only it was part of your group. Okay, same example I have explained as an example. Entity A owns 100% of the shares of B since 1/4/2011. A arranges a loan funding from a financial institution in a newly owned subsidiary called Entity C. Arey Baba. A is there, it has got in B. Now it will form a new entity called C. The loan is used by Entity C to acquire 100% of Entity B. Your own subsidiary. You wanted cash. So you formed a new company called C. C took a loan for which A gave a guarantee. And you sold your subsidiary to C. C gave you cash. Aha, beautiful way of converting loan into sale proceeds. Now the structure will look like A, you have got C, you have got a B, and your balance sheet is filled with cash. Loan is sitting in somebody's standalone, C's standalone financial statement. A's standalone financial statement is very clean because you sold your investment, you got the cash. So without affecting any financial ratios, without showing any risk to the investors, your balance sheet became cash rich. CFS. That's why we have CFS, no? 100 years back, there was no CFS. People would have done all these things. That's why some investors, no, immediately parents, they will go to the CFS of the parent. A very clean picture you are going to get. That's why we learn now, 110 next. If this was not there, people would have done, no? The CFS would not have there. That's why, see, how instantly an account, see, so you are coming from an accounting background. Instantly you said, sir, it will be caught in the CFS. Yes. All these hanky-panky things, what you are doing, no? Giving loan, transferring there, taking this money. Clean in CFS you will see. Now entity A applies 103 to account for common control transaction, and entity C will adopt the same policy. Fair value of the identifiable assets is 1,50,000, carrying value is 1 lakh. How entity C will apply acquisition accounting in the CFS? They have told you entity C will adopt the policy, entity A applies 103 for common control transaction. How fair value of the assets is 1,50,000, carrying value of the assets is 2 lakh or 1 lakh, and they have paid you 2 lakh rupees cash. How entity C will apply acquisition accounting in its CFS, because it has to prepare a CFS now. Will it do the common control or will it do the acquisition accounting? Why? Now, who are the parties to the business combination here? B and C, correct? Now, who was controlling both the parties before? Now, who is controlling A? Now, why you should go for acquisition accounting? So, you say explain what is common control. It should not be transitory, because it is not a transitory, no. You set up and immediately purchased and sold. You have established now to take over. So, in the given case, it is a common control transaction because before and after acquisition, both the entities are controlled by entity A only. Previously, entity B was directly controlled. Today, an acquiry called entity B is indirectly controlled through C. That's why you cannot use fair value uplift. That means when entity C takes over entity B, the CFS of entity C should have book value of entity B. Understood? Perfect. No, see, this understanding is required for tomorrow's discussion, and I wish more and more questions you ask me on reverse acquisition. So you see the structures, no, how the people try to do, what all things they do. Because it is see, if you are permitted, no, then it's like it's transaction myself. No, I am doing with myself. See, I want to tell people that I am rich outside. So in one bank account there was one money. I put it in another bank account and say I have become rich. Is it? Will you accept it? No. If somebody else's bank account, if that money comes into my bank account, then I say I have become rich. That people will accept. But from my own transaction with myself, because at a CFS level, you have got this transaction between two subsidiaries. No, both C and B will listen to you. What if B was different? Will somebody will listen to you for this type of arrangement? No, no. That's why not to mislead people by including fair valuation in your business, they said you have to do common control transaction with book value. Otherwise, it is misleading. It will give you a misleading balance sheet, inflated balance sheets. Entity. This can be a probable question in the examination, and you have to tell me here. Very beautiful. Please understand this. At least among all the questions, I wish I give more importance to this. Entity A and B provided construction service in India. Okay, two entities were there, two real estate company or God knows what it is. Entity A is owned by the group of individuals, none of whom has got a control, and they do not have a collective control arrangement. Now, who is owning that? Some minority must be owning. Like for example, A Limited is 100% owned by some group of people. They don't have any interrelationship or they don't have any understanding. Now, who is the owner of this A Limited? Who takes the decision? That means among this, who is the majority minority? One person, no, somebody must be owning it. That already we have seen some initially, one minority related thing. Now, entity B is owned by one single guy called Mr. Ram. This is the structure. This is scenario 1. He is Mr. Ram. Now, the two entities A and B decided to combine their business. Okay, now these two wanted to merge together. God knows A wanted to take over B or no, B wanted to take over A. Is it common combination or it is business acquisition? Business acquisition, because A is owned by somebody else, B is owned by somebody else. Now what happens? It did it very interesting. Owners decided the consideration will be settled in the shares of entity B. That means I am going to issue the shares to B. Entity B issue new shares amounting to 40% of the issued capital to the controlling shareholder Ram. Already you have some shares, additional shares they will issue. Entity B issues new shares amounting to 40% of the issued share capital to its controlling shareholder Ram. Already you are holding something 100, no? Say 140%. Say for example, I will issue additional shares. On account this arrangement only, you see something they do. Mr. Ram then transfer the shares to the, means what happens? No, this company directly will not issue anything to the owners. This company will issue shares to them, and he will shares and owners of A and exchange their interest in A. At this point of time, Ram controls both the entity A and B. Means this company will not take over. Generally, in all our previous cases, what used to happen? B is to take over A by issuing its shares to the members of B, A. This is what we have learned, no, right from the beginning. In this case, the arrangement was a little different. B issued its shares to A gave their shares to the members in return for their shares to this. So the new structure looked like this for time being. Scenario B, the structure looked like this. Now, who is owning A and B? Ram. And then Mr. Ram had a controlling interest in both the entities before and after combination. And then he gave A Limited shares to B Limited. And the new structure looked like this, where in B Limited, 28% is owned by all these previous shareholders, 71% is owned by Ram, and A Limited 100% shares are owned by B. And in this question, now if this type of question comes, I am suggesting you please draft one this chart, otherwise you will get totally confused. Now, is this combination A and B are common control combination? Nice, no? Nice way of arrangement, no? Common control. Yeah, but when B acquires A, is it common control or is it not common control? Now this situation, now this combination happened. Who has to prepare CFS? B has to prepare CFS. My only question, will B use pooling of interest method or will it use acquisition method? Just tell me that. Question is clear, no? Now CFS has to be prepared by B for acquiring A, because previously nobody was nobody's subsidiary. After B acquired A became B's subsidiary. Now Ram is claiming, sir, I will apply pooling of interest method because before acquisition and after acquisition both were under my control only. So I will take over A's value in CFS at book value. Why? Because I will follow pooling of interest method. You are an auditor. Is it okay with you? Or it looks like one whitewash there? Huh? Yeah. That's what I'm asking. Will it come under acquisition or pooling? Management is claiming they will do under pooling. Is it okay? Okay, let us see this. 103 defines combination, means prior owner should be same and all of the story, except control should not be transitory. Now this is a transitory control. No, simply to create A limited under pooling of interest method, what did you do? Instead, B limited issuing its shares to the 28% to the owners, they routed it through RAM. Like previously that was transit company. This time there is no transit company, there is a human being. One human being was used as an instrument to route an acquisition to show that this is a common control. But in reality, it is a normal business acquisition, no. So in the given case, okay, transitory not defined and all, it is not a common control because Ram's control is only a transitory control there. Substance actually B acquired A. So in the CFS of B, you have to follow acquisition method of accounting and not pooling of interest account. Followed, no? And understood what happens in reality? Okay, so that's why if reverse acquisition, this accounting would not have been there. We don't know, students, what would have happened. Okay, last I think one question is there, I believe. Yeah, this is the last question. Sita, this is called a dual listed entity. I will explain you what it is. You remember one case we discussed, that acquisition can happen through contract alone. That means nobody pays to anybody. That is called a dual listed corporation. Like suppose one bank audit, I told you 10 partners are required. We are partner, you are 5 partners. So we will create one organization called that will distribute. Now both of your partnership firm and my partnership firm will form one new partnership firm, and that partnership will apply for that bank audit, telling we are 10 partners. That's called like a dual. That means we will continue. You will continue in your individual capacity. I will continue. We have come into existence only for one particular purpose, to apply for a bank audit. Those type of organizations are called a dual listed corporation. Now, who acquired whom? Wait, that's what we'll see. Sita and Beta decided to combine together, forming dual listed corporation. Dual listed means you will continue your existing listing also, but a new company also is listed. See how word has changed. As per their shareholder agreement, both the parties will retain their original listing, and the board of directors of dual listed company, how it will be comprised. Now question comes, okay, you both of us for part one partnership firm. Who is the managing partner of that new thing? Will you say 50-50? If you say 50-50, then this becomes 111. Joint operation. It becomes joint operation, no. That means, let us see, it is not 50-50. The board of directors of DLC comprise of 10 members, out of which 6 will be from Sita, 4 will be from Beta. Now, who is controlling this dual listed company? Sita is going to control. The fair value of Sita Limited is 100 crore and fair value of Beta is 80 crores. The fair value of the net assets of identified assets are Beta is 70. Why? Because in the name, see here we have got dual listed corporation. Zeta, beta. It is same like your Mira, Zira and Zira. In the name of dual listed corporation, beta was acquired by Zeta. This person becomes legal acquirer, accounting acquiry. Is something like a reverse acquisition. Now assume the NCI to be measured at a fair value, determine the goodwill to be recognized on acquisition. Okay. Now Sita Limited has got more board of directors, majority control. That's why Sita is the acquirer, beta is the acquiree. We need not talk about accounting acquirer and all, leave it. If this question comes, please write as it is whatever I am giving. And one more thing, all this theory question, no, if you refer the real study material, no, para number, so many things they have given. So I have customized for your examination answer. Just write this, more than sufficient. So don't think more. It's very nicely organized also. And I'll give the print at the end after it is done. Dual listed corporation is formed, and this case of business combination is achieved without purchase consideration through contract alone. So the goodwill is to be recognized in the business combination achieved through contract alone only when NCI is to be measured at a fair value. Because there is no consideration paid, no. That's why if you follow proportionate asset method, there is no goodwill because you didn't pay anything. So if you follow fair value method, yes, there is a goodwill to the extent of that NCI. In case NCI is measured at a proportionate asset, no goodwill will be recognized. So how the goodwill will be calculated? Purchase consideration nil, because this Zeta didn't pay anything to beta. NCI at fair value will be 80, because they said they will fair value the NCI, fair value of the beta itself. That means 100% of in this dual listed corporation, 100% stake is NCI only, no, because you don't hold anything. And fair value of the net asset is 10, so goodwill is 10. So your journal entry, only for your understanding, your answer ends up to here, examination. If you measure at a fair value, your accounting entry will be fair value of the net assets, goodwill to NCI at fair value. That means if you control any entity only with the contract, not by investing any single rupee, you will consolidate, but 100% you will show as an NCI. Understood? If you measure at proportionate net asset, your accounting entry will be fair value of assets to NCI at proportionate net assets. There is no goodwill on your account. That means whatever goodwill you show here, this entire goodwill is related to NCI. Perfect? Yes, students. So with this, we are done with the majority portion of your business combination. Okay, the last aspect is left, which is your reverse acquisition. With this, we are done with the business combination.